Hey guys, and welcome to another video. Today I'll explain a simple guide to investing for beginners. I'll start by listing what you need. You need money or income which you can then invest, and it should be income you don't need in the next few months. What does that mean? You need at least 2 months of work income as safety if you depend on your income, or better free. Everything in excess you can if you invest if you want, but you can decide yourself how much you want to have in cash, or maybe invest some money in 3-month or 1-year government bonds of your country if it's trustworthy enough to pay that back. Then you'll need a network connection, but you're watching this video so you probably have one. I recommend you to use a PC or tablet, meaning a bigger screen, to look at the graph of stocks or at financial statements, but you shouldn't buy one just for investing. And you'll need a broker. There are many different brokers you can to choose from, depending on where you live. I personally live in Europe, so I mainly use interactive brokers because it has some nice trading options too. But you can use Trade Republic, eToro, or Scalable Capital, or others if you want $0 ETFs in the case you want to invest less than 50 euros per month, but still want to invest every month. This may be an option for you. If you live in the USA, or you can use interactive brokers or TD Ameritrade. If you live in other countries, you can search for the best brokers in your country, but internationally the most useful broker is interactive brokers, and I personally use it myself. And now let's get started with how you can invest. You can dollar cost average into an ETF like the S&P 500 or your country-specific index, or the MSCI World for a more international index. And you can invest in stocks directly, but I recommend to not only invest in stocks but also in an ETF to secure your portfolio, because stocks can greatly can go up and down a lot more than an ETF can. Depending on your knowledge of stocks, you can structure your portfolio 50-50 or make one part smaller. Like if you don't know much about stocks, maybe 0 to 30% will be in stocks and the rest in ETFs. And if you know a lot about stocks, you can make stocks 50 to 70% of your portfolio, or even 100. But I would only do that when having 5 years of investing experience or more. You can also invest in government bonds while waiting for stock investments, but in most cases you need 1,000 to 2,000 euros to invest in one bond, and this, depending on the size of your portfolio, this can be a large amount. First, I will explain to you how to invest in an ETF. You can search for an ETF you like using the site in the description, which you can see right here. Because there will be almost all ETFs listed on there, and indices. Which indices do I recommend? Good international indices are the MSCI World or the FTSE All World. USA indices, which could be seen as international also, because the MSCI World and S&P 500 have mostly the same companies, for example. Could be the S&P 500 or the Nasdaq 100 if you want to have more software companies. But the Nasdaq 100 is riskier compared to the S&P 500, but it can also grow more. European indices would be the Euro Stoxx 50, or for example the German index DAX is also really good, but doesn't perform as good as the S&P 500. If you want the best performing and equally safe index, I would recommend to invest in the S&P 500 and maybe combine that with a good index in your country's currency, which with national companies, 50 to 50 or maybe 80% S&P 500 to 20% other ETF. You can use an international ETF combined with the S&P 500 too, but many of them feature the same companies like Apple or Microsoft. That's the ETF side of your portfolio, but how do you invest in an ETF? You can either invest the position of your portfolio all at once, or dollar cost averaging, meaning you or dollar cost average, meaning you invest part of your portfolio every month or every couple of months. Both have advantages and disadvantages. Investing all at once can make you a higher return every year depending on when you buy, but you have the risk to buy near the top and have great losses over a long period, which can be stressful and should be avoided depending on how much performance you want from your investments. Or you dollar cost average, which can lead to a slightly smaller gain, but will probably almost all the time be in the green, meaning you will see your money growing the entire time or after a few months since starting to invest. So I personally use dollar cost averaging for ETFs and investing all at once for stocks, but you can choose yourself. Just a little graph to show you why investing all at once is bad. Look at the S&P 500 from 2000 to 2010. Depending on when you invested, for example, if you invested near the top of the 2000.com bubble, you would have made a 40% loss, which isn't that nice. But if you would have used dollar cost averaging, then you would have had times where you had a loss, but also times where you had a gain, and your average price would be more in the middle, like around 110, maybe instead of $140. But until now, both investment styles have made a profit because the price grew after that to around 450 is it today, I think. So let's start talking about stocks. You can invest in a company you like, but that company could be overvalued and you could make a loss. So I recommend to value a company and invest based on how much your valuation tells you the company is worth. I can't explain the valuation process in this video because it would take a while, but I will briefly talk about other stock investment methods. You can also use dividend stocks to earn an income every month, but you should look at the cash flow of a company compared to the amounts they pay shareholders as dividends to see if they really have that money or not. What is a dividend, you may ask? It's an amount of money a company pays out to their shareholders every year. With most companies, it's around 0.5 to 3% of the stock price per year. With dividend stocks, you can make 3% per year, but the dividend can grow, and with some companies, you eventually make 100% or more in dividends every year. But undervalued companies can bring you 10 to 20% per year through the stock price going up, so it can perform much better. Finally, let me tell you how you should look at a stock. Don't look at it like just some value or a number going up or down. It's a business making money every year, and you should look at how much of the money you get every year and if it's growing. And I emphasize, don't invest more than 10% of your portfolio into a single company because that can be quite risky. Some very experienced investors do that, but there are so many stocks to choose from, so you don't have to take that risk. Just wait for the company to get to the price you want to buy it for. I will talk more about stock valuation in another video. Let's now quickly talk about bonds. A bond is a debt a government or company takes on. You can lend the government money for a period of time and they will pay interest on it and pay it back after that time, hopefully, which isn't always the case, but with governments like the USA or Germany you will most certainly get it back because these countries are really trustworthy when it comes to paying back bonds. In contrast to that, a company can easily just file for a bankruptcy and you won't get your money back, but for that risk you get a higher interest payment. In times of rising interest rates, such an investment can be useful to grow your money at nearly 0% risk of losing it, but it will most likely underperform stocks by a huge amount after a few years, and it would probably not even be enough to win against inflation, making your money less worthy. So I just recommend you to invest in bonds for the time you're waiting for a stock to get to a certain price, but you can also use options for that. More on that in a later video. And only invest in government bonds because company bonds are more risky. So I just recommend to buy bonds with a small amount of your portfolio, around 10%, or if you are retired with a bigger amount. That's it for this video. If you liked it and found the information useful, you can give it a like, and I'll see you in the next video. Bye.